Investors, perma-bear stock market appearances, doomsday economic black swan market calls, breakout the 1987 stock market crash cart replay, and it's the end of times, zombie apocalypse calls garner 10 to 100 times the attention, clicks, and views in the financial world than those of, it's not different this time. History rhymes and repeats, and we've seen this before, or we're back to the old normal. Hey, just pull up the number of views my videos have gotten over the last 3 years, while largely being correct in both price and time in most twists and turns in the level of the stock markets since the COVID lows in the late first quarter of 2020, versus those of the myriad of largely wrong but loud and promotional negative financial community. While statistically usually wrong and financially unprofitable to long-term investors, folks, fear sells well in the financial markets. The old normal keeps playing out in 2023, almost to the week and day. That was the title of our 2023 market outlook penned way back in December of 2022. And that's what we continue to see year to date in the stock markets, regardless of the doomsday calls throughout 2023. The S&P 500 bottomed and turned up right on cue for the fourth quarter rally. Friday, October 27th, at the end of institutional tax positioning. Investors, that was the end of the final full week in October. The Oak Harvest investment team had discussed this outcome for months, all the way back in June and July. Why? Because investors, like it or not, financial news swirls or not, that's what the old normal looks like in the financial markets. 3 weeks ago, my Oak Harvest financial stock talk was, it's make or break time. In the week of the market's low on Friday, October 27th, it was, is it really different this time? The 2 links to those videos are in the description if you missed them. Investors, last week we updated real-time data we watched, and we've been sharing with our clients and followers in advance over the last 4 months during the market's summer sell-off, which we stated was about to turn up. That was the week Santa Claus has a calendar in Bloomberg. For years, I've been asked what I thought about various economic data, political positions, and global tensions, and much to the dismay of most, I continue to call them like I see them. They should not matter much yet to the old normal. And the old normal says, while the end is near, it's not this week, this month, or this quarter in the financial markets. This week, I'm going with the highly promotional, eye-catching, and self-serving title. Investors, the end is near, but it's not today. Please take a moment to click on both the subscribe and notification bells so you'll be notified when our investment team uploads our latest content. Okay, so the S&P 500 traded down and to the right in a very normal seasonal fashion since the mid-July top at 4,600. Take a look at the chart of the S&P 500 since last October 2022, its pivot low. You'll see the overall market went nowhere since mid-June of this year and closed slightly below the 200-day moving average the last full week of October on cue. Similar to 2022, similar to 1999, and even similar to the 1987 crash cart calls by many lobbing out historically inaccurate stock overlays as the S&P 500 looks nothing like it did in 1987. While many of those calls were put out and forced by a host of financial TV personalities, the Oak Harvest team was messaging there was finally a favorable environment for the market to turn higher. So investors, what would the future look like under a continuation of the old normal? Folks, there's both good news and bad news on that front. First, the good news. Take a look at the daily average return of the stock market for the close for the last 80 years from Merrill Lynch. Break out your reading glasses and you'll see that statistically speaking, we're in the seasonally strong period for the US stock markets through the year end. In fact, while many TV financial personalities were pitching doom and gloom at the end of October, they missed the bottom of October 27th. Many traders and investors were still negative, saying that the market had moved way too far too fast, and they didn't like the markets at 43.60 to 43.85 as well. Investors, the bad news for them is, historically, they blew it. They missed their chance to buy the low. So just last week, I got calls from friends and trader friends after the markets had rallied almost 250 points in 8 to 9 trading days saying they were going to buy a dip. They were going to buy a pullback. And then those same associates called me a day later and told me how bad it looked that the squiggle down move on Thursday, November 9th, and that they had pulled their buy orders and they were going to wait for lower prices. And what happened? A near vertical day on Friday, November 10th. Like it or not, historically, the market won't let these traders or investors in at decent prices until it's after Thanksgiving. I've done the research, and it said the normal is the market rallies almost all the way back to its summer peak before it allows anyone in a material way. Yes, you heard that right. Normal is regained 4,600 on the S&P 500 in only about 4 weeks. 4 months of losses recovered in slightly more than a month. It always starts with short covering excuses, but stock buybacks, negative positioning and sentiment, and better demand versus supply of stocks in November and December usually rule the day. Many investors and TV commentators have discussed how bad breadth was for the market all year. They've justified their bearish stance by saying there weren't enough stocks working or outperforming the markets year to date. Statistically, they're correct, with a few of the biggest market cap stocks having carried the markets year to date. However, having missed the move in the overall S&P 500 year to date, will they now reverse course and get bullish because of a very rare and historically bullish Zweig breadth thrust that occurred on November 3rd? I doubt it. It didn't sound that way when I was watching financial news channels, even though we've talked about the rarity of these events over the last 5 years. Since the 1930s and past the Great Depression, the broad NYSE has only had 17 Zweig breadth thrusts. Only 17 times, that is. The S&P 500 is up 100% of the times over the next 130, 190, and 250 trading days, with an average annual return of 16.3%, 20%, and 22.7% respectively. This equates to between 5,000 and 5,100 on the S&P 500 in the early second quarter of 2024, and is statistically and historically very possible. Of course, no guarantees in the stock markets, but coincidentally, this is where the Oak Harvest team has placed the optimistic first half of 2024 outcome for the markets for over a year. As for a visual template of what a continuation of the old normal might look like for the remainder of the fourth quarter of 2023 and the first quarter of 2024, I once again update a chart I've referenced for about a year, comparing the first 2 years of the internet build-out and bubble, 1998 through 2000, to the current AI cycle build-out land grab that started October of 2022. Here's the S&P 500 overlay for those time periods. To date, the market moves in many asset classes have been eerily similar to the day and week. I challenge you to explore this topic and analogy of time periods more on your own research. For those investors who are history and chart junkies, here are 2 more indexes overlaid for those same time periods: the October 1998 through March 2000 internet bubble, and now what many think is an AI bubble. Take a look at the smaller Russell 2000 index chart. And finally, the SOX semiconductor index chart. Take a look at that. For those of you who are skeptical of this historical analogy or reference as a comparable time, I have to ask you if you recall what semiconductor company came public in their initial IPO in early 1999. You get one guess, but if you guessed Nvidia, you'd be correct. I challenge you to overlay Nvidia's stock chart from 1999 and now, 2023, and make a good argument for why it isn't different this time. So the good news is, no, the end of the rally should not be today, or next week, or even this year. And this rally should end from higher levels that few investors or strategists have consistently forecast. However, if this historic analogy keeps up playing its tune, volatility should increase in the beginning of 2024, and post the first quarter, it will likely be a very, very difficult environment for the overall markets, and particularly passive index investing. Investors will likely be better served by gravitating towards more actively trading strategies and ones that can hedge or even take short positions in the markets, sectors, or single stocks. However, for now, the 2023 summer sell-off that we forecast from July was not different this time. And seasonally, the Santa Claus rally, starting late October and lasting into late December and potentially extending into a volatile manner in the mid-March of 2024, won't be either. The future in stock markets are always uncertain. That's why our retirement planning teams plan for your retirement needs first and your greed second. From myself, from Troy, Jessica, and the rest of the team here, have a blessed weekend.